Morning everyone, and thanks for joining us for this webinar, The Case for Listed Private Debt, Learnings from the GFC. Under different circumstances, we'd have liked to be able to do this session face-to-face with you all, but given the circumstances, a webinar it is. In these strangest of times, I hope you're all healthy and coping okay, whether working from home or managing to get into an office. And for those of you in Melbourne, we're certainly thinking of you and hoping your current lockdown works as hoped and that you're able to get back to some level of normality soon. Just want to remind people that the webinar is being recorded, so will be available to rewatch should you have colleagues who you think might benefit from the content we share today. Today you have three of us on the call. I'm James Brown, a portfolio manager on our global listed private equity strategies, and I work with Lisa Swanton on the Barwon Global High Income Fund and with Bob Blue and the rest of the team on the global listed private equity funds we manage. Joining me today is Lisa Swanton, who will lead most of today's webinar. She's been with Barwon since 2013 and is an investment manager in our team, and she takes the lead on researching the listed private debt funds. She's also responsible for portfolio construction of the Barwon Global High Income Fund, while also being supported by Sam Armstrong, Bob Blue, and myself. Sam Armstrong is a founding partner of Barwon and was the architect of our flagship Barwon Global Listed Private Equity strategy, which was launched in 2007. Sam has over 30 years of private markets experience and leads our team across these strategies. The three of us are part of a broader listed private equity team of 5 investment professionals, including Bob Blue and Kate Hayward as well. We're further supported by additional internal registry management and fund administration teams. This morning, I'll give a brief introduction to Barwon Investment Partners, then we'll get into a discussion about listed private debt investments, a market that the team here has been investing in since 2007. We'll talk about the state of the market at present, noting some similarities to the GFC and highlight the opportunity we currently see in the market. We are keen for this to be interactive, so do encourage you to post questions into the webinar portal as we go, and we'll certainly have plenty of time for Q&A at the end. Barwon Investment Partners was founded by Sam Armstrong and Rob Morrison back in 2006 and since grown to a team of 30 people managing over $1.5 billion of assets on behalf of institutions and wholesale clients. Barwon's Global High Income Fund, which we'll talk about today, sits within our global investment strategies, which includes our flagship listed private equity strategy and single asset private equity co-investments, which we make from time to time. Barwon's other investment strategies are healthcare property, which was launched in 2013, and property finance. Healthcare property has grown strongly in recent years, and Barwon manages 2 funds in this sector. Firstly, the Barwon Healthcare Property Fund, which is open to wholesale clients and invests in Australian primary healthcare real estate assets such as local GP clinics and healthcare precincts. The second fund is the Barwon Institutional Healthcare Fund, which buys and owns larger healthcare real estate assets such as base hospitals and pathology labs on behalf of larger institutional clients. The third pillar of Barwon's strategies is property finance, a strategy which Barwon has established over recent years and includes single asset investment funds, which typically make first mortgage loans to high quality Australian property developers on conservative leverage ratios. Barwon's also currently raising money for the first multi-asset property finance fund, which will invest in a portfolio of these loans. Before I pass to Lisa, I'll give a very quick summary of our fund, the Barwon Global High Income Fund. Barwon has invested in listed private debt securities since 2007 as part of our global listed private equity strategy. Having seen the opportunity in the sector and the attractive yields on offer particularly, the team here at Barwon seeded the Barwon Global High Income Fund in 2014. The fund's been incubated with Partners Capital until quite recently, when we've decided to offer the strategy more broadly. We see it as an attractive way to generate a high yield with the potential for capital growth over time as well, and having an overall attractive risk return profile. All the securities we invest in are listed on major stock exchanges, which allows us to offer good liquidity. Unit pricing and dealing is currently monthly, but as the fund scales up, we'll look to move that to daily dealing. The management fee is 65 basis points with no performance fee, which we see as attractive for an actively managed strategy of this type. At this point, I'll hand you over to Lisa, who will give us an introduction into the sector and the opportunity as it stands today.
Hi everyone, and thank you for joining us. Bit of feedback there. Thanks for joining us today. As James introduced, I'll take us through the current market opportunity we see for listed private debt and why we think this is a particularly interesting time to be investing in the sector. Before I do that, I'll just quickly explain what we mean when we say listed private debt funds and define the opportunity set that we look at. So what we're illustrating on this chart in front of you is at the top of it is the Barwon Global High Income Fund, an unlisted Australian unit trust, in which we're buying a concentrated portfolio of globally listed private debt funds, names such as Ares Capital Corp and Blackstone Mortgage Trust, with the investment philosophy of the fund being to provide liquid private debt exposure. So taking Ares Capital Corp as an example of a listed private debt fund, this is a publicly listed company with a portfolio of self-originated loans to US middle market businesses. The other example I highlighted, Blackstone Mortgage Trust, this makes loans backed by commercial property. To a smaller extent, we're looking at companies that make loans within niche sectors such as venture capital backed loans and asset-based lending. So the common theme when we look at listed private debt funds is that the loans are directly originated and being held to maturity. The core subset of our universe, and you'll hear me mention these companies a bit today, is a group of companies called business development companies, or BDCs. So quite simply, the BDCs make loans to US small and mid-sized businesses, typically companies with an EBITDA of $10 to $100 million. Common example of a loan that a BDC would make would be to provide the financing for a private equity buyout. So just through the Barwon Global High Income Fund, we're not looking to invest in traded loans. The important distinction is that the companies make a majority of their income from cash interest and are focused on buy and hold strategies. As James highlighted, Barwon's been investing in listed private debt funds since 2007, and we seeded this dedicated strategy, the Barwon Global High Income Fund, in 2014. The private debt asset class has grown considerably over recent years, and this growth is supporting the expansion of the listed private debt fund universe. I'd highlight two tailwinds that have been building for private debt since 2009. Firstly, persistently low yields across traditional fixed income markets has fueled a global search for yield. And secondly, industry-wide retrenchment of banks from lending activities, particularly to small and mid-sized businesses in the US, has created a massive financing gap, really allowing these non-bank lenders or private debt funds to come into the market and scale. The private debt market is over 800 billion in total assets today. The listed private debt market that we focus on, there's over 120 companies in our universe with a combined market cap of approximately $100 billion. What investors are sometimes unaware of, and there's a few names on the screen in front of you, but is the presence of established mainstream asset managers with listed private debt funds, managers such as Blackstone, KKR, Goldman Sachs, Bain Capital. So why you've all joined us today. This equity market sell-off that we've seen this year has opened up an attractive opportunity to buy these listed private debt funds. At current valuations, the funds are trading on a 23% discount to their June net asset values and paying a 12.4% dividend yield. As we present the slides on the market opportunity, most of the metrics we've used refer to business development companies and middle market loans, but the themes we're discussing hold true across the broader universe. So the chart on this screen presents the calendar year-to-date performance of listed private debt funds during this market dislocation. And we've displayed the performance against various indices. So in the gold line, we have the performance of listed private debt funds. And after trading in line with the market through January and February, they declined a somewhat surprising 57% from that February peak to March trough. And today, the share prices of listed private debt funds are still down 28% from February peak. If we compare that to the performance of the S&P 500 in the light blue line on the chart, the S&P 500 fell circa 30% peak to trough, half that of listed private debt funds, but is back trading close to that February peak valuation. High yield bonds 5% behind their February peak. We're highlighting this opportunity because this lagged recovery of listed private debt funds after a broad market sell-off diverges from what we've seen historically. In other periods of market dislocation, yes, we've seen listed private debt sell-off in line or more than the market, but we've seen much stronger recoveries. Post the GFC, listed private debt funds recovered twice as quickly as the S&P 500, and through that recovery offered returns of 43% in calendar year 2009, 51% in calendar year 2010. So the questions we're asking and answering today is why they're lagging the market recovery. Are they poised to recover? I think it's fair to say the level of drawdown was higher than we would have anticipated coming into this market sell-off, but there were some technical factors that impacted this and may well be impacting the recovery. But as we've seen in other periods of market stress, the market tends to drastically overestimate credit losses. The unknowns of this pandemic are clearly reflected in these distressed valuations of listed private debt funds. However, we're optimistic that the credit loss performance of listed private debt funds will outperform what the market is currently pricing in. So on this next chart, a little bit of detail to go through, but so just to introduce, most of the listed private debt funds in our universe are focused on senior secured lending strategies, including first lien unitranche loans. On a look-through basis, the Barwon Global High Income Fund has a 90% exposure to senior secured loans. So these lenders or listed private debt funds are at the top of the capital structure and have a first claim over the cash flows or assets of the business. So on this slide, just reading from left to right, we're looking at the credit loss experience of middle market loans and comparing that to the credit experience of broadly syndicated loans and high yield bonds. So on the light blue bar chart, we show the default rates. So senior middle market loans have exhibited a lower default rate historically than both broadly syndicated loans and high yield bonds. On those loans that have defaulted, the principal value recovered has been in line with broadly syndicated loans and far better than high yield bonds in the grey bar chart at the center. This lower default rate, superior recovery rate, translates into a lower annualized loss rate when compared to high yield bonds and broadly syndicated loans. There's a number of reasons we could point to for the credit performance of senior middle market loans being superior and why we think that relative outperformance of middle market senior loans will hold during periods of market stress. Some of the factors that's driven this superior credit performance, listed private debt funds directly negotiated terms with the borrower or private equity sponsor, offering a level of control and workouts. Listed private debt funds have ongoing access to the financials of the companies they're lending to, allowing for close monitoring and, most importantly, early warning or detection of underperformance. The private equity sponsor, often backing the loan that the listed private debt fund is making, is very important. The ability of the private equity sponsor to provide top-up equity in periods of market stress is valuable. And anecdotally, what we're hearing from private debt fund managers through these second quarter reporting is that private equity sponsors are stepping up with equity support for portfolio companies.
I think it's fair to say, looking at this, the way the market stands at the moment, I think the market doesn't seem to be appreciating that these middle market loans in which the BDCs are investing actually have historically better credit metrics than broadly syndicated loans and high yield bonds, yet the market as it stands at the moment certainly is pricing them that way.
So just a real look at this historic credit performance, the current equity market valuation suggests to us that listed private debt funds have been oversold. So a valuation metric we analyze in looking at the listed private debt fund is price to net asset value. So in this chart, we've plotted the price to net asset value of publicly traded business development companies over time. And the short story is this March 2020 sell-off we've seen before. So looking at the period from 2007 to 2009 on the chart, BDCs went from trading at a 40% premium to trading at a 70% discount at the depth of the crisis. Following a strong recovery in 2009 and 2010, post the GFC, really the sector has traded within a relatively tight band since then, with there being a reversion to net asset value over time. However, in March this year, the sector went from trading at net asset value to trading right down to a 57% discount to net asset value. It's recovered some of that and is now trading on a 23% discount today. However, current equity market pricing offers 18% capital upside should the sector return to trading at its trailing 5-year average valuation multiple, or 30% upside if it returns to trading at net asset value. So this price discount to premium valuation metrics gives us a quick snapshot of the market, individual companies, but it doesn't paint a full picture. So firstly, there's wide dispersion of the valuations of listed private debt funds, some trading on 60% discounts still today, some back trading at a premium. Another thing this chart doesn't capture is what is net asset value and how have the net asset values of listed private debt funds performed. So on this next chart, we look at how the net asset values of listed private debt funds performed. So BDCs fair value their investment portfolios quarterly. At 31 March, BDC loan portfolio values were written down approximately 7%. This translated to a 14% decline in net asset value. The 7% decline in loan values was largely mark-to-market write-downs or unrealized losses driven by the widening of credit spreads. Breaking down that March valuation further, we saw senior loans decline less than 5%, whereas junior loans were down approximately 10%. In the June 2020 quarterly reporting, loan portfolio valuations did improve, circa 2%, largely from the unwinding of some of those first quarter unrealized losses. So combining this, from December to June, net asset values have declined 12.3%, largely due to unrealized markdowns of loan values. Listed private debt funds have historically been quick to write down loan portfolios and slow to write them back up. So whilst we expect a gradual reversal, such as we're seeing in June, of the March quarter unrealized markdowns, we're not expecting 100%. There will be credit losses incurred, but the lower net asset values today do offer a potential upside over time. So on the right-hand side of this chart, we've combined the potential capital upside from improved net asset values with the potential upside from the improved equity market valuations we discussed on the previous slide. The effect of a recovery in net asset value combined with a recovery in share price valuations offers up to 35% capital upside from here, allowing for a level of credit losses. Even within that band, there's considerable upside opportunity. So the 57% drawdown. So I think just what I want to make clear here is there's just a real disconnect, I guess, between equity market valuations and loan valuations. So we saw 57% drawdown in share prices through March, but only a 7% write down in the underlying loan values. And then finally, these listed private debt funds are paying an attractive 12.4% dividend yield today. The key question we often get is to understand where that yield premium private debt funds generate over traditional fixed income asset classes come from. There's multiple sources. The illiquidity premium of originating private loans. Some is earned from additional economics with the loan terms such as upfront fees or repayment fees, or restructuring fees that we're currently seeing for the second quarter. There's sometimes additional yield earned depending on the size of the company that the lender is lending to, or where in the capital structure the lender is providing its financing. So private market activity has been limited through the second quarter to provide us with a lot of insight as to how much has changed during the pandemic. But whilst we're sitting here with considerable uncertainty on the economic outlook, we do think the listed private debt market has the opportunity to yield significant returns for investors. So I will hand back to James to wrap it up before we go into Q&A.
Thanks, Lisa. And I guess really the question here is why should an investor own this? And I think Lisa really highlighted the disconnect as the equity market has shown to the underlying loans, and really highlighted that capital return potential from this strategy through a level of reversion to the mean. But in the meantime, that you'll certainly be receiving a double-digit yield while you wait for that capital recovery. As you can see on the on this slide here in the top left, our fund holds a portfolio of 17 listed loan funds, listed private debt funds, with an underlying portfolio of over 2,000 underlying loans, 90% of which are senior secured and diversified across industries and sectors. So in terms of the fund, it is an Australian style unit trust, open to wholesale investors. We have two Australian-denominated unit classes, one which is unhedged, so it gives you exposure to the US dollar primarily, with a small amount of pound sterling exposure. We also offer a second share class, which is substantially hedged back to Australian dollars. The strategy is very much value oriented. We're looking to generate a sustainable yield of 8+%, and some capital growth over time. But as Lisa highlighted at the moment, the market is paying a yield substantially higher than that. Unit pricing and applications redemptions are currently monthly. We pay a quarterly distribution, and the management fee of 65 basis points, as I highlighted earlier, with no performance fee, we see as compelling for this type of strategy. At this point, I'll open it up to questions, or I'll hand over to Sam Armstrong, who will kind of moderate the questions. And so if you've got any questions, we've seen a few good questions come through the portal already, which Sam will moderate. And if you've got any further questions at this point, please plug them into the system, and we'll look to get to all of your questions. Thanks, Sam. Over to you.
Thanks, James. We've had some great questions coming through. Lisa, I might direct the first one to you, which is, I heard you mention BDCs. Can you just tell us again, please, what is a BDC and are they available in Australia?
Sure. So a BDC, or business development company, it's a type of investment company, a US investment company. So they invest in small and mid-sized companies in the US, created in 1980, not available in Australia. It is a structure that's unique to the US.
It's worth highlighting that the BDC structure was really created to encourage lending to US small and mid-sized businesses, and so the BDCs get very favourable tax treatment.
Next couple of questions coming from Andrew. The obvious path to recovery is corporate action. Are you going to be activists, talking to activists, leading on boards to follow the path of even bigger names like Alcentra? So I think the idea is, are we going to be engaging in corporate activity?
Look, I think that is a very fair question. There are a number of subscale BDCs or BDCs which are trading at wide discounts, which certainly could be candidates for corporate action. We have seen some corporate action in the last couple of years, which has been positive, and some consolidation. I mean, at the scale we're at the moment, we probably can't exert the influence just yet. We would like to see more of this activity because we think it's good for the sector, but not in the short term, I think would be our answer.
Okay. Now the next question is a tough question. Might have been coming from someone in lockdown, but as an asset class long term, BDCs just destroy NAV over time and therefore returns far less than its yield, despite survivorship bias. Are BDCs investable as anything or as anything but a trading play? I might, before handing that to you, James, take a stab at that. I think that BDCs through the cycle have delivered, mixed performance, it's fair to say. However, the sector's been characterised by some very, very good performance, what we consider institutional quality stocks, and some lesser performers, which we would consider just have never been institutional grade and have been unlikely to ever achieve their sort of targeted returns on equity. I think what we've seen, though, especially over the last 5 years, is a real improvement in the overall, quality of both the managers, quality of the terms on which they're managing loan portfolios, and I think now you will see BDCs both improve their returns to shareholders as a total category, and we will become a very mainstream investable asset class. James, Lisa, I don't know if you've got anything to add to that.
Oh, I think you've nailed the key points, and for me the key point really is that historically it has been a very retail targeted structure, and there has been a bit of a lack of quality in a number of the management companies which have managed these BDCs. As you say, that has improved somewhat and continues to improve. I think the prior question, in terms of corporate action, reflects that. I think better shareholder or better governance and better terms for shareholders, and our view is that the sector is improving and will continue to improve. In terms of the question about are they only for a trading opportunity, I think the trading opportunity is, in our view, is clearly there now, and over time I think it can certainly be more investable through the cycle.
Lisa, can you give us an example of one of your largest investments in the fund?
Yes, sure. So one of the largest investments, and it's been a core holding in this fund, and we've also held it over time through our listed private equity strategy, is the largest public business development company, Ares Capital Corp. This is a company that's generated sort of a double-digit return on equity nearly every year since it's been public, I think, except 2009 when it generated a 7 or 8% return on equity. So, an outperformer and for shareholder returns, but we've still seen some equity market dislocation even across that name, which allows and offers good opportunities to buy in at a discount to net asset value.
Very good. How confident is the team on the 30 June valuations for BDCs? And I might just append to that question another question, which is what look-through visibility do we have to the underlying loans?
Lisa, why don't you take that one on the visibility, and the visibility will partly lead towards the answer on the confidence in the NAVs as well.
Sure. So the business development company and some of the other companies within the listed private debt fund universe, great transparency on their underlying portfolios. They produce a full schedule of loans, so you get company name, maturity, coupon, where in the capital structure the business development company is invested, but also they fair value their loans quarterly, so you're getting the cost, but you're also getting the fair value mark. So we can track it loan by loan, quarter by quarter, which we do. They use third-party valuation firms, either valuing 25% of their portfolio quarterly, that you can rely on. Some of the names give pretty good disclosure on the inputs and metrics that they're using for those quarterly marks as well. I mean, the
Lisa,
one thing that is just through June, what we've seen is that BDCs are focused on their existing portfolio companies, on working with those companies, ensuring they have sufficient capital. So we've seen a pretty low level of deal activity within the private debt market, of new deal activity through June.
James, one for you. What kind of volatility can be expected from the funds through the cycle?
Yeah, good question. And look, I think that really goes to the heart of it. The discount opportunity there is significant now, and unfortunately that highlights that there is this level of equity market volatility. It'd be nice to get the purely a book value return here with the premium that they're yield premium they're generating. But I guess that's the price you pay for having that liquidity that these trade on market. Now we've done some analysis, and over the previous 5 years or so, leading up to the correction in March, the BDC sector exhibited a beta of roughly 0.5 to the S&P 500. But clearly, as you can see, in periods of market stress, these do tend to sell off sharply with the market, or indeed even more than the market at times. And we've been particularly surprised this time that while it has sold off even more than the market, it hasn't recovered. And that's as Lisa highlighted during the slides earlier. That's what's been particularly different this time around to previous periods of market stress. Historically, the sector has rebounded sort of twice as quickly as the broader equity market after a period of dislocation.
A couple of questions from Tom here. I think this is a very, very good one, so we might spend a bit of time on this one. How has COVID been impacting the fund portfolios, small to medium-sized companies in the US?
Very good question.
So I guess let's just talk about the impact of COVID on portfolio companies. I suppose, and we might just take it from go back to March, talk about what the initial fears were, and talk about what's transpired since then in terms of non-accruals, credit losses, and what we're hearing anecdotally from the underlying managers.
Lisa, do you want to? I'll start by saying, clearly, as with all markets, the impact of COVID has been very uneven. We've seen that in the broader market, that anything which is software technology enabled clearly has been a net beneficiary, where anything hospitality, travel, leisure, and so on has really been overly impacted or quite severely impacted. I'll pass to Lisa. Lisa can talk a little bit about the sector breakdown within BDC portfolios in aggregate, but also some of the sort of specific commentary we've had from managers, as Sam said, at 31 March and then 30 June as things have started to recover.
Sure. So we've done quite a bit of analysis, actually. As I mentioned, there's very good transparency on the underlying portfolios, which allows us as top-down level to sort of look at those look-through industry exposures that we have. So when we did a first pass, just looking at our industry exposures, listed private debt funds had circa an 11% exposure to those industries we classified as first-order impacted businesses, or those industries, looking at S&P data, that were expected to be hardest hit in terms of revenue and earnings. So ultimately, a low exposure, and that has supported our thesis that credit losses through listed private debt funds will be lower than what the market is currently pricing in. The other part of the question, I think, was how has it impacted lending to companies? I think as I mentioned, we haven't seen a huge amount of new lending activity in the private debt market yet, with companies focused on current and existing portfolios. But a lot of managers are talking to looking a big source of deal origination through the last few years have been very competitive, but a big source of origination has been existing portfolio companies for the business development companies. We're continuing to see that, whether it's providing additional lines of financing as required, but we are seeing credit spread widening, and I would expect to see them being more opportunistic with available capital through this quarter and subsequent quarters.
It might be worth also just touching on conversations we've been having with the private equity sponsors that we talk to more broadly through our listed private equity strategy. And it's fair to say that at the end of March, which was really the depths of the sentiment, expectations for Q2 were very low. Having now had second quarter earnings and conversations with managers, it's become quite clear that operating performance in their portfolio companies has, in general, with exceptions clearly, but in general been actually quite well ahead of where they set expectations back at the end of March, which, as a flow through, just gives us that little bit more confidence on the private loan portfolios as well.
I was going to say, our modelling suggests that most companies continue to service their debt up to about a 50% loss in EBITDA. Now, S&P's outlook for sort of leisure, travel, gambling, oil and gas, those most impacted sectors, is for about a 50% loss in EBITDA. Now, we don't think they have any particular special crystal ball, but I guess what we're hearing both and seeing in the reporting and hearing anecdotally from our managers is that it is a very narrow base of companies that are being more severely impacted than that, which we think bodes well for a bounce back in valuations. So a related question coming in from Tom is, what is the forecast of distress levels and bankruptcies for small and medium companies, which are a lot more vulnerable than the bigger companies? So if we could just talk broadly to, what again our managers are guiding us towards in terms of distress and bankruptcies and where we think things might ultimately wash up.
Thanks, Sam. Lisa, are you happy to take that one?
Sure. So, I mean, looking at sort of liquid credit markets, the expectations or the forecasts that we're sort of seeing for defaults would be sort of kind of high single digits. In terms of guidance for defaults within the private debt portfolios, it isn't something that is provided, but what we do track quite closely is the actual fair value marks, and we're tracking any companies that are on non-accrual that have stopped paying interest, and we're also tracking a watch list companies which might have a mark of sort of below 0.8 times cost. And what we're seeing is we've had a very benign credit environment. That non-accrual rate, those portfolio companies not paying interest, is really only kind of in 1 or 2% across the business development companies. That is increasing. We're seeing the number of companies sort of double, or that's ticked up to sort of 3-4% through portfolio companies, which isn't unexpected as companies sort of preserve cash flow through this crisis. Also, our watch list has increased as we saw, those fair value markdowns have come down. So we expect sort of middle single digit realized credit losses through these companies, just based on what we're seeing in terms of those fair value marks for those companies no longer servicing their debt.
Lisa, can I just, but how does that compare to the experience through the GFC?
So peak non-accruals through the GFC or realized losses, they sort of peaked at around 10% through the GFC. So our expectations through this are lower than what was experienced through the GFC, but the market is pricing in more than what was experienced through the GFC.
Very good. Okay, next question coming in. Are the funds in which you invest leveraged?
Yes, it's a short answer. So BDCs have limits on the leverage that they can have on their balance sheet. They're limited at 2-to-1 debt to equity. That was increased about 2 years ago from 1-to-1 debt to equity. And most manage their portfolios within a target of 0.9 times to equity to 1.4 times. Today, the average is about 1.2. That has ticked up because technically, as portfolio valuations were marked down, naturally your debt to equity multiple has increased. That's at 1.3. Commercial mortgage REITs we're investing in do have higher leverage. They're usually levered about 2.5 times debt to equity.
Okay, but still much lower leverage than you'd see in a regional bank or something like that.
Yes.
Certainly.
On the whole, quite lowly leveraged. James, might direct this question to you. How and where would the Barwon Global High Income Fund fit into a multi-asset portfolio?
Oh, good question. Look, I think, if you think about the characteristics of this, it pays a very high yield, which, currently sort of double-digit yield. So it's definitely an income generator for your portfolio. Given the capital volatility, you certainly wouldn't describe it as a traditional fixed income or replacement for term deposits, that sort of thing. But as an alternative source of income, so I think it's pretty attractive. So for us, we really think alternatives, income generating assets, but observing that there is some capital volatility there.
Okay. Another question about volatility. I mean, I think that in relation to volatility, we see essentially two classes of investors. One are investors that really can't stomach the volatility and choose to invest through unlisted funds, thereby getting the benefit of the smooth fair valuing of return of valuations, and those that will consider listed public funds. Typically, they're investors that might have a need for liquidity, or that might be investing tactically. But I guess let's perhaps address the question of the volatility of these funds again. And I guess it is a feature of these funds, and I guess it also has an impact over what time horizon you might consider investing in them. But perhaps, James, I can throw that one to you for a comment.
Well, I think you kind of nailed it there. I mean, I think the underlying loan portfolios have generally performed well over time. It's really been a question of equity market volatility. At this point, clearly trading at discounted valuations, we think the risk return profile is particularly attractive. You're going to be paid your double-digit distribution yield, and actually it's a key feature here that while there have been some selective dividend cuts across the sector, the distribution yield has been remarkably resilient. So you can expect that consistent distribution, and from this point, certainly expect capital growth. But as you say, the volatility is unfortunately a feature of the sector, and the way we see it somewhat is the volatility is sort of the price you pay for that regular liquidity. For those who are able to lock their money up for 5 or 10 years in a closed fund, then they obviously don't need to take that volatility. But we certainly know plenty of investors who aren't able to take that sort of lockup and illiquidity, and so this is the liquid option. And also highlight that volatility creates opportunity at certain points in the cycle, like present.
Yep. Are there any types of funds you tend to avoid? I might answer that one firstly, Lisa, before passing to you. But I think there's definitely one type of fund we've learned to avoid, and that's the newly established fund that could be a cash box type fund looking to get invested. Because what we've found over time is that they compete very heavily, mostly for syndicated loans, deals where it's very easy to deploy capital. And our real preference is to invest with those managers that are making the hold to maturity loans with clients they may have invested with before. So we've noticed that many of the managers with better track records in this space serially lending to the same companies. So one manager, Golub Capital, for example, something like 80% of their loans are simply lending to a company they've already lent to. So we're very leery of those companies that under pressure to very quickly build out their portfolios. Lisa, have you any additional comments there?
Yeah, what I'd add to that is, we've been investing in listed private debt funds, Barwon has, since 2007. So, we've had the opportunity to track most of these companies and managers over that time. We have pretty strong relationships with most of the managers in the listed private debt funds. So at the moment, how we're investing is we're investing with those managers we know, those managers who've managed vehicles through a cycle. We're not just going and buying all the names still sitting on a 60% discount. We don't want to stretch right down the risk spectrum. We want to buy those managers who are trading on a discount to where they've historically traded, to where we think they should be trading, but with managers that have proven underwriting capabilities, proven sourcing capabilities, and outperforming.
I think that's probably a good question to finish on. We're running out of time here. I think just reinforcing that the focus is definitely on the quality credit managers, the credit managers with that well-established platform and good track record, while we do from time to time take more opportunistic investments when obvious situations of distress present with obvious catalysts or drivers for that re-rating. But look, thank you everybody for joining us today. That is about all we've got time for. If there are any questions, further questions you have which we haven't answered today, then please do get in touch with us. The recording will be available, if not later today, tomorrow. And thanks for joining us. Have a good day.
Bye.